Most investors believe the key to success is finding a new opportunity, a new stock, a new cryptocurrency, or a new breakthrough. But the truth is, many are already experiencing losses. This isn't because the market is against them, but because they've never learned how to protect their money. Benjamin Graham, who taught Warren Buffett, the pioneer of value investing, had a single principle that distinguished the intelligent investor from the careless gambler. They called this principle a rule, a simple and sound rule. In a world obsessed with growth, overexcitement, and bold risk-taking, Benjamin Graham became a quiet reminder that true wealth begins with protection, not perseverance. Warren Buffett was a pioneer of value investing and a pioneer of rational finance. But what made Graham so striking wasn't his wealth of knowledge, but his profound understanding of its limitations. From his perspective, defense wasn't a sign of weakness, but a sign of wisdom. He once said, "The essence of investment management is managing risk, not return." This quote encapsulated a truth often overlooked in today's world. Investors today chase the next popular stock, the trending cryptocurrency, and the big breakouts. But it's important to remember that Graham's principle, never losing money, is more than just a warning. It's a philosophy. It's a mindset that extends beyond the stock market. It's a matter of lifestyle, mindset, and stamina. Because when you truly grasp the meaning of never losing money, you stop gambling. You stop chasing. As Graham envisioned, you begin to live a calm, rational, and untouchable life. This isn't just a rule, it's a way of life. This is Benjamin Graham's secret principle. Graham aimed to teach not just how to invest, but how to think. He believed that predicting the future is wrong, and preparing for it is important. For Graham, preparation always began with a fundamental priority: protecting your capital. A true investment was defined as an asset that, after thorough analysis, guarantees the safety of capital and a sufficient return. Note the order: safety over profit, excitement over excitement. Graham grasped a truth many people never realize. You don't win the game of wealth by chasing huge profits. You win by avoiding catastrophic losses. Every great investor he influenced, Buffett, Klarman, Munger, built their fortunes on this idea. Because compound interest doesn't just reward genius. It rewards resilience. Graham called this the margin of safety, the difference between an asset's value and the price you pay for it. The wider this difference, the more secure you are from uncertainty, mistakes, or unfortunate circumstances. Imagine yourself crossing a bridge that is fully capable of supporting you. It can withstand, until one day, you can't stand it anymore. The consequences of investing without a margin of safety are similar. You can profit for many years, until a single mistake shatters everything. Graham's genius wasn't in his ability to predict the future. He protected against the future. Wealth is built not by blindly taking risks, but by managing them. The important thing isn't how fast you can rise in good times, but how your foundation holds up when things shake out. Because the investor who survives in any financial environment eventually owns the market. Many people think of risk as price fluctuations on a screen, but Graham interpreted it differently. Real risk, he said, is not price fluctuation. It's the permanent loss of capital. In other words, danger isn't a temporary setback. Danger is a sinister concept that silently destroys your future. He witnessed generations of investors lose everything. This wasn't due to bad luck. It was due to poor choices. They ignored the rule, never lose money. Because when you succeed, the math is against you. Even if you lose half your fortune, you'll need to make 100% of it to recover. This isn't an opinion. It's a mathematical fact. And mathematics never deals with optimism. Graham understood compound interest better than anyone else. The smaller your margin of error, the quicker and faster your wealth grows. Compound interest is unforgiving. It magnifies it. Every dollar, every figure you lose, is like an eternal soldier in the struggle for financial freedom. Therefore, Graham emphasized the importance of discipline, not emotion. Logic and humility were at the core of his method. He built it on the principle of margin of safety, reinforced by emotional control. Only buy things worth more than you paid for. Don't let fear drive you out. Don't let greed draw you in. For Graham, investing wasn't about making predictions. It was about survival. The market wasn't a casino. It was a teaching ground. Every mistake was a lesson. Every win offered a lesson in patience. Graham's philosophy wasn't about avoiding risk, but about respecting it. Building wealth comes from withstanding every downturn. It doesn't come from anticipating a big win. He often reminded his students, an investor's greatest problem and enemy is probably himself. This statement remains true even today. The market doesn't destroy wealth. It reveals your weaknesses. Benjamin Graham's existence revolved around providing protection, not chasing predictions. Margin of safety was more than a financial concept. It functioned as a kind of psychological shield. Choose to think like an engineer. When you design a bridge, you don't build it to carry just the average load. You build it to carry twice as much. Because life doesn't follow your calculations. Graham also applied this wisdom to investing. Don't design a portfolio that works in good times. Build a portfolio that can survive in bad times. Margin of safety simply means buying a solid company at a reasonable price. It's not a weak company with flashy stories. It means holding cash when others are risking everything. It means leaving room for error because you can't avoid making mistakes. Security may not be exciting. It doesn't go viral. But Graham knew that security is the foundation of every fortune. He once said, "Whether the crowd agrees with you doesn't mean you're right or wrong. Whether you're right is up to your facts and logic." This is the essence of margin of safety. Independent thinking based on discipline. Consider two investors. One is always looking for excitement. He constantly checks prices. He feels great when prices rise and is devastated when they fall. The other buys value. He studies the business thoroughly, ignores the noise, and lets patience do the work. 10 years later, only one will survive. Because time rewards hedging, not foresight. The market, like gravity, constantly tests your structure. Graham's students, Buffett, Munger, and others, survive because they build portfolios the way engineers build bridges, not for the sake of impressiveness, but for the sake of lastingness. And that's why his teachings resonate even years later. Not because they're grandiose, but because they're true. The security-conscious investor doesn't just protect their wealth. They also protect their peace of mind. The modern investor faces more data and less information than ever before. Graham warned about this before smartphones, apps, and constant notifications. He knew people would mistake movement for progress and noise for information. He called it the speculative impulse, the need to do something even when patience would yield greater wealth. And this is precisely where so many people fail today. While they wait for the next growth opportunity by scrolling through charts and headlines, they ignore the timeless truth. In the short term, the market is a voting tool. In the long term, it's a weighing tool. Benjamin Graham often said, "The market exists to test you, not guide you." And this saying rings true every decade. The Great Depression occurred in the 1930s. Inflation and oil crises followed in the 1970s. The dot-com bubble burst in the 2000s, and the financial crash of 2008. But investors who grasped Graham's principle not only survived, they thrived. Why? Because they adopted a different way of thinking. They understood that emotions trigger real market crashes. Fear and greed, these two hidden forces, move faster than any stock chart. If you can analyze them, you can influence your results. That's why Graham's most important lesson wasn't about picking the right stock. It was about developing the right mindset. He taught that success in investing is independent of being smart. You just have to avoid mistakes. Avoid the emotional traps that turn smart people into gamblers. Don't overpay for stories. Don't mix excitement with analysis. Don't let short-term emotions ruin long-term compound returns. This was Graham's fight against this speculative impulse. People have a tendency to act simply to feel good. Sometimes the wisest choice is to do nothing. Modern investors don't generally all lose because of bad calculations. They lose because of their impatience. They perceive movement as progress and busyness as productivity. In reality, both are often forms of panic. Graham observed this many times. People were doing what everyone else was doing, ignoring logic and following trends. Every cycle eventually reaches a similar conclusion. The crowd is at its most enthusiastic just before a crash. He used to tell his students, "You can't manage the market. You can only control yourself." Here lies the essence of Graham's mindset. The ability to act rationally in the face of uncertainty. The ability to remain calm when everyone else is losing their minds. For Graham, the stock market was like a reflection. It revealed your true identity, not what you should buy. Did you worry when prices fell? Did you get greedy when prices rose? Your reactions revealed more of your character than your portfolio ever could. Patience over speculation. Discipline over excitement. Process over emotion. These were Graham's fundamental principles. He believed that the greatest gains, both financial and life-related, came from reacting less. The less you chase, the less you panic, the more time stacks in your favor. He called this rational patience. Not laziness, but the ability to remain steady amidst chaos. Because never losing money required not just protecting your wallet, but also clarity, peace, focus, and time. Graham experienced many crises, panics, and crashes, but he never collapsed. He viewed chaos not as a disaster, but as a given. This is the fundamental difference between a gambler and an investor. A gambler makes decisions based on emotion. An investor, on the other hand, makes decisions based on principles. When you start thinking like Graham, many things change. You stop thinking about asking, "What's next?" And you start asking, "What's worth having in life?" You stop valuing predictions and focus on the facts. You stop chasing profit and learn to stand firm. You start seeing patience not as a weakness, but as a skill, because you discover that surviving is just as difficult as winning, and that's far more rewarding. Graham wasn't promising people overnight wealth. He was trying to guide them to become rational individuals throughout their lives. When you master your behavior, money will follow, because wealth gravitates toward those who wait. His teachings go beyond finance. They influence how you deal with challenges, how you make decisions, and how you build your future. The discipline that protects your portfolio also protects your life. The patience that grows your investments also develops your character. Graham's philosophy wasn't focused on predicting the future. It was based on enduring the future. If you can remain calm, determined, and strong while the world turns rapidly, you have already won. Because true wealth isn't measured in money. Its measure is peace of mind. Benjamin Graham didn't leave behind a company. He left behind a mindset. He laid a timeless foundation for Warren Buffett, Charlie Munger, Seth Klarman, and generations of others who built their wealth rationally and with calm patience. His wisdom wasn't about getting rich quick. It was about building a life that endures. He taught that an investment, whether of money, time, or energy, should first provide security, then return. Because if you think about it, your life is an investment portfolio. Every choice continues to accumulate. Every habit generates income. Every feeling you master contributes to your long-term peace of mind. The rule never changes. Never lose money. But more importantly, don't lose yourself. Graham's most important legacy wasn't his financial theories. Emotional discipline is the courage to think independently under constant pressure to respond. And Depth Invest represents exactly that. We're not here for hype. We're here to cultivate clear thinking, to make sound investments, to stay cool when everyone else is panicking. Because true investing isn't about timing the market, but about mastering your own nature. Our goal isn't to get rich quick. It's about building habits and a mindset that keep you rich. Graham once said, "The essence of investment management isn't about managing returns. It's about managing risk." And that's what you're doing now, managing risk by strengthening your mind. If this philosophy resonates with you and you believe wisdom is more important than hype, join us. Every week, we learn timeless lessons from history's greatest financial minds and how to apply them today. Subscribe to Depth Invest. No noise, no exaggeration, just enduring principles. Ultimately, wealth isn't about predicting the future, it's about preparing for it. If you live by Graham's rules, protecting what's valuable and remaining disciplined, something powerful happens. You realize Graham dedicated his life to teaching. You were never chasing wealth. You were becoming it. Ultimately, wealth isn't about chasing numbers. It's about protecting what truly matters: your time, your peace, your purpose. Benjamin Graham taught us not just to invest, but to think. So as you walk his path, remember his rules. Don't try to be fast. Don't panic. Never lose yourself. Because wisdom always grows.